Welcome back to Morning Line. We're talking taxes with Dr. Friday this morning before the end of the year, which is really a critical time because it's the end of the tax year too.
Absolutely, absolutely.
And so Dr. Friday's kind of filled us in on some things you can do to save a little bit of money before the end of the year. Also interested though, there's going to be a little bit of change with some of the forms we get from our employers. And if you're a small business owner or a business owner, you're going to need to know this too.
Right, this is really important because one of the things you need to know is W-2s and 1099s have to usually be to the employee or the vendor by January 31st, and then we usually had 30 days to make sure there was no mistakes or anything before we filed it. Now we have to have it to the IRS by January 31st, which basically means we need to have them out by January 15th to be able to fix any mistakes because, again, someone gets married, forgets to tell the employer, someone moves, forgets to change the address, all kinds of little things like that can happen, and then we have to then do a lot of amended returns. It's just a lot more work for us. But make sure that you have that. The reason they're doing that is because of fraud. I mean, that is kind of a great move from the IRS. Less fraud in the tax system would be a lot easier for you and me as consumers.
Sure. Let's go ahead. We've got another question from Tom here. Hey, Tom, good morning.
Hey, good morning. I was wondering if you could talk a little bit about the advantages of filing married or single. If you are married, filing separately. I have student loans, so I was wondering if it might be beneficial to file separately and if there are consequences for that or any benefits of that.
Yeah, no worries. And that's an awesome question because a lot of times people will come in and we are talking about the different tax brackets, and a lot of times people will want to file married filing jointly or married filing separately. Seems like a pretty con. The problem is there's a lot of penalties involved with married filing separately. One would be student loan interest. Since they don't really know how much your spouse, and as a combined income, I think it's like $115,000. If you make more than that as a combined couple, you're not allowed to take the interest deduction. Therefore, they won't allow it at all as married filing separately. Excuse me. So you can only file student loan interest on a married filing jointly or a single or head of household. The other would be earned income credit or even some of the child credits and energy credits. Because there's tops of incomes for all of those different things. If you have a child in school and you want to get the educational credit, you won't get that if you're filed married separately. All of those kind of come into play. So yeah, I would suggest if you have a tax person, the best answer to that would be is to go in and ask them to file it both ways and get a good, find out which way is going to give you the best. A self-employed person, a lot of times will file you married filing separately because, let's be honest, you're in a higher audit section than a person that's an individual with a W-2. So your married spouse may not want to take that liability on. There's a shield then. If their name's not on that tax return, the IRS can't come back and collect back taxes on a tax return. So it gives them a little bit more protection.
How does auditing work? I mean, just, normal people, non-business owners, how likely are they to get audited?
Not as likely. We have a couple cases that usually come up, but most of the time it has to do with stock sales or usually something to do with a capital gain situation or where something's different than normal, right? W-2s are not really a question, but there is a thing with the IRS. They will do a number of them because what they want to make sure is even though you think that you have a very simple tax return, maybe there's more money going through your bank than what you're earning, and that's what they're looking for is unreported income for individuals that maybe have little hobbies or things that maybe should be being reported as a hobby income because there's more than $10,000 going through their bank in a year.
So it's still good to write your goodwill receipts out, but
receipts. Yeah,
but not something you need to stay up at night about.
Yeah, well, yeah, I would say taxes should not be putting you to that kind of stress, in all honesty. But this is why these kind of shows and doing it early, get your little organizer, start throwing the things by category into that all throughout the year, and then that way at the end of the year, worst thing you have to do is a tinky or take the calculator and calculate the totals by those categories. But you've got all the receipts, and what's awesome, scanning now is accepted by the IRS, so you don't have to keep those big boxes stacked up in your office or whatever in the attic where the receipts are slowly fading away, so people bring them 2 years later and there's nothing else. You can scan it all in at the end of the year after you've prepared your taxes and everything is on a digital. Back it up someplace safe, but other than that, you're in good shape.
How long do you need those receipts for? I mean, can they say, I need your receipts from 10 years ago, which of course you don't have?
Yeah, 7 years is what we like to have saved. If you have 7 years, but again, all that can be scanned in, so you can have it out in Carbonite or some outside system, whatever you use, and then that way then you don't have to have the boxes and your documentation still safe.
Save it to the cloud. Hope that you can find it again, though.
Well, that's another thing. I mean, 20 years from now, you're not going to care because it's out in the cloud, and you don't really. Well, of course, it won't be the cloud 20 years from now.
So, for people who are filing for the very first time, what are the documents they need? What are the things they need to know if they're tackling this for the very first time?
Yes. What I'm finding out is a lot of college kids are actually self-employed on top of it. So let's take the easy ones. W-2s, 1099s, most of them do not own a home in the first year that you're filing a tax return, because you usually need 2 years taxes to purchase a home. So you probably aren't even going to be itemizing. But so those would be the two. And normally, if it's under, I think, like 30 or 40,000, there are some services out there that are free for people with just W-2s. So just do a little looking around and find out, so that way you don't have to pay someone to prepare your taxes.
If there's like a TurboTax or something online, or
yeah, and if you're a senior, I know AARP actually has some free services as well. But if you are selling stock, a lot of kids I have found they're getting into the stock market, buying and selling. So you're more not quite a day trader, but the concept of it, you may have too many transactions on a Schedule D, so you're going to want to make sure you have the basis and the sale prices. Or if you're in a small business, receipts. You keep saying it, I can't say enough. Make sure you have all those receipts. Educated guesses when I ask how many miles and you're looking up, well, I think about 20,000. That's not going to fly.
Right. Because anything to do with a job search or what you're doing for work, if you're not getting paid for it.
Tracking all that is awesome. Unfortunately, if you're not itemizing, most of that probably won't come in, but you don't know if you're going to itemize many times until afterwards, and then it's hard to go back and recreate it. My concept is, especially nowadays with online banking, go through and label that stuff. Job search fees, travel to do an interview, whatever. At the end of the year, you can actually pull reports nowadays, and it's pretty pain-free. Train yourself young.
So I know a lot of people are wondering, because obviously we're talking about this tax year right now, but possibly some big changes coming next tax year. At least that's what we've been told. We've got a new administration coming in. I know President-elect Trump has promised a lot tax-wise to impact both individuals and businesses.
Yes.
Kind of give us an overview of what that could mean for us.
Yeah, it can be exciting. Unfortunately, we've seen several presidents come in with high hopes and not necessarily been able to, but it would be great. I mean, this particular president does have more of a business background, so we're hoping he's going to reduce some of the taxes. Corporate taxes are, the second highest in the whole world here in the United States. It doesn't really help the money move as much, so we're hoping that that's going to come down closer to 15% versus 30, 35%. You're also looking at the income brackets. We have 5 income brackets right now. We're looking to bring that down to 3 income brackets. Again, anything that would theoretically simplify, unfortunately, every time they use that word simplify, it just adds more to the tax code, and it's already bigger than the Bible. So we really have we do need to simplify it if that's possible. But yeah, so his idea is to reduce the overall, give more credits, but then take away some of the credits. Some of the people that are going to, he doesn't believe in necessarily increasing the minimum wage. He's not going to be looking at increasing the earned income credits and some of those things. He wants to give people credit that are working, so he's trying to give more back to the people that are actually working than people that may not be as much working, and the current tax code kind of rewards less work. So it'll be interesting to see how that will come out in the act, because right now if you make more than about $25,000, you lose quite a few benefits. He wants to change that, where if you're making less than 25, maybe your benefits are less, but give more to people that are in what we consider mid-America, 25 to 55. Give more tax credits to them so they have more disposable income.
What does actually reducing the number of brackets, realistically, what does that do?
Well, it just basically means that you'll have more people in the 10 to 15 bracket, where we have a progressive tax code right now, which basically means, even though we always say 10, 15, 20, 25, 28, 30, it gradually goes to those brackets, right? You don't just immediately go to 10 and then immediately jump to 15. It will work its way up to that. So he's going to enlarge the 15 tax bracket, which right now for a single person is like, let's say $70,000. It's going to go like to $100,000. So you're going to have people, again, he's really working for the middle class to have a little bit more disposable income. So he's trying to expand that, and then the higher income bracket will kick in at, I think, $250. So everything between is really going to be the middle income bracket. So anywhere, but so I think it's going to work out a lot better, and he's going to eliminate the marriage penalty, which right now, as many people might know, as a single person, if I sell stock and I have anything over 100 grand, no big deal, or 200,000, excuse me. But as a married couple, they only get 250,000. That's a huge penalty.
Yeah.
So, you know, I'm just saying. So there's several things in the tax code that has that kind of penalty. He wants to eliminate a lot of those. So single or married, you know, is a double situation, which should be fair, in my opinion. You know, we shouldn't penalize for people for getting married.
I think the one that the most people, you know, the most jaws have dropped over, I would say, would be the business proposal that he has. I mean, you were talking about it earlier. It's very substantial.
Yes.
Do you think that there's a possibility of that even happening?
You know, I do, because even the Democrat and the Republicans both ran on reducing the corporate tax. Not as much on the Democrat side versus the Republican side, but both were going to bring it down. The reason for that is we are penalizing people like, let's just, Coca-Cola has billions of dollars sitting in other countries that will not bring it in, because his is not only going to change the corporate rate here, but he's going to also eliminate the tax that has to do with bringing money into this country. That's huge, because these people want to, but I mean, as a tax person, am I going to tell you, leave the money, work it over there, because if you bring it in here, you're going to pay another 20%? Why would I pay 20% to bring my own working capital back into this country?
Sure.
It doesn't work for, so he's going to actually expand a lot of that. So hopefully, we'll see. I mean, again, you got to have a lot of people that agree. The president might say it, but it doesn't know. The pen is mightier than the word is not going to work on everything.
All right. Well, let's get to Jim right now. Jim, good morning.
Good morning.
What's your question for Dr. Friday?
Yeah, Dr. Friday, just a quick question about inheritance tax. I received an inheritance from my father's estate from Kentucky. I was just wondering what my obligations are as far as federal and state taxes in Tennessee.
Well, if you've received it, there's not going to be a whole bunch. Are you the executor of the estate?
No, I'm not.
Okay, so the executor of the estate would have to file, Kentucky has a different inheritance than we do here in Tennessee. But when it comes down to it, plain and simple, in Tennessee, our inheritance follows the same as the federal, which basically means, what, $5 million or something like that. So unless you inherited more than that, there's really nothing for you to file. The only thing you'll be filing would be on any growth. So if this was in a savings account and you may have earned interest, you'll have to pay tax on that interest. If it's a IRA, you may have an inherited IRA where there's required minimum distributions that have to come in. But other than that, if it was just cash given to you, there's nothing for you to report.
All right, Jim, thanks for the question. Let's talk about some things that, how do you make sure you don't get audited? What are the best
Audit-proof.
tips to keep you audit-proof? What's the best way to do that? Whether it's an individual or maybe small business owners are watching.
Well, I think, and you know, we keep pushing down, but documentation. If you take something on your tax return, I don't care what it is, if it's your W-2, if it's a 1099, if it's housing credits, whatever, have that document. How did you come up to that number? Why are you putting it on the tax return? You are audit proof if you can justify the numbers on your tax return. You're not audit proof if, like I was teasing and I said to you, what's your mileage for last year? And you look up and you come up with a whole number of $20,000. That is not audit proof. You need to have a mileage log that says, why did you drive someplace? Where were you driving? What was the beginning miles? What was the ending miles? That makes you audit proof. So really just documenting it and keeping, especially for the self-employed, keep your calendars. What were you doing? Because even if you might lose something, if you have a calendar that says I met with these people, we have the ability to at least talk and say, hey, we met these people. We could go back, find out these people met with. I mean, there's ways of us to justify certain expenses, especially if you're flying or traveling a lot. And using credit cards are great. Just keep in mind the IRS does not accept a credit card statement that says American Airlines or Office Depot. They don't know where you went. It just says American Airlines. You could have taken the kids to Disney World. You know, you could have went to Office Depot and brought all your children's school supplies. So we need the document. We need the receipt that shows toner replacement or whatever it was that would explain why you took that off as a supply. So good documentation.
Okay, good stuff to know. We'll be right back.